What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over a very strong headline that came out on the markets on December 30th, which basically suggested a stock market crash is on the horizon. Expert warns a 42 to 65% drop in the S&P 500. So very similar to Michael Burry, this is another market expert apparently, John Hussman. He's the president of Hussman Investment Trust, and he basically laid out the case for why the markets are going to see a significant decline and absolutely no returns for the next decade. For the next 12 years, there's not going to be any returns from the market. He has been correct in 3 out of those 3 calls in the past. He called the dot-com bubble in 2000s. He called the great financial crisis in 2007 and 2008, and he also predicted that the S&P 500 would see no returns in 2000 after 2000 for the next 10 years, which it actually did. So there is some validation with his analysis, and that's exactly what we're going to discuss. I'm going to break down what the entire thesis is all about. As always, make sure that you drop a like. All I'm asking in return is that you subscribe to the channel if you haven't already. Links to our Discord and Patreon is going to be down below. There is a 16% annual discount that does expire at the end of this month. So you've got 2 more months left if you want to take advantage of that. And again, link's going to be down below. You do get access to all the members only videos, Excel spreadsheets with my fair values and my entire watch list, and of course Discord access with a lot of Discord channels, including buy and sell alerts, options alerts, trade ideas. Everything is going to be included in there as well. So link's going to be down below. We'd love to have you on board. So, stock market crash. Expert warns for a 42 to 65% drop in the S&P 500. So earlier this month, as we already know, the Jerome Powell and the Federal Reserve signaled that the Federal Reserve would take a more dovish stance in 2024. There's going to be a lot of cuts, which is what the market's pricing in. And the Federal Reserve is also expecting for a quote-unquote soft landing for the U.S. economy, where interest rates are potentially going to come down on the back of inflation getting down, and the economy and the labor market continues to be very resilient and strong. But John Hussman is skeptical that the Fed pivot can provide the kind of juice for stocks that investors are expecting. He's kind of skeptical, and this right here are the 2 things that kind of are going to hold back on the continued outperformance from the S&P 500. Number 1, stock valuations are near their most elevated levels in history, and investor sentiment is actually not as strong as it needs to be to continuing lifting stocks as well. So those are the 2 reasons: stock market valuations and investor sentiment. When it comes to determining the market's valuation, Hussman prefers his measure of market cap to gross value added for non-financial stocks, which he says is most accurately forecasting long-term market returns. And his measure has been cited by fellow bear and investing legend Jeremy Grantham in recent interviews as well. And in the chart below, it's apparent that the current market cap to gross value added levels are above those seen in both 1929 and 2000, when stocks were at the precipice of 2 of the biggest declines in market history. And this right here is where we are, with basically considering the non-financial corporate gross value added, GVA, estimated as domestic non-financial GVA times 1 plus the profits of the rest of the world divided by domestic profits, and of course taking into account the market cap of these companies. And right now we are almost at an all-time high as of December 14th, 2023. Of course, we did see a pretty significant decline in 2022. So this right here was the entire bear market, and now we're recovering back up to almost a new all-time high for this particular indicator. Other common measures, of course, is going to be the Case-Shiller cyclically adjusted price to earnings ratio. So in other words, the CAPE ratio. And right now it's sitting at 32.6, which again, historically is almost twice as much as the all-time average, which again does suggest that the market's valuation is very far-fetched. In other words, it is expensive right now for the markets, and we're nowhere near close to our 2000 dot-com bubble levels from 45 to 42, but of course even 32.6 is a pretty elevated level, nowhere near close to the 2022 peak, which was at over 40, because earnings have grown and prices have also recovered, so that ratio is a little bit less than where we were back in 2022 at the beginning of the bear market, but that is still, again, pretty elevated according to Hussman at over 32.6. And when it comes to investor sentiment, which he refers to as market internals, Hussman also uses his own measure. It basically looks at how wide the participation in a market rally is among individual stocks, also known as market breadth, something that we have talked about. And Hussman says that this offers a window into the degree in which investors are inclined to speculate. And the chart below from a November note shows the measure represented by the red line. When it's flat, internals are unfavorable, right? So when it starts to become a little bit more flat because there's a lack of participation in the market, that means internals and market breadth is unfavorable and stocks tend to underperform. And this is easy to see in 2000 and 2008 as well. So what he's referring to basically is a time period when this happened, where the red line market participation started to basically there was a lack of broad participation and market internals were weakening. So you can see the consolidation here basically going sideways, and both instances, of course, the markets declined pretty aggressively over here. And right now we're kind of witnessing a very similar situation where, again, you can kind of see the consolidation flat here, markets kind of going sideways. This right here, again, basically going sideways for this market internal. Markets dropped over here. Markets dropped pretty aggressively over here as it was going sideways. And now, once again, we've seen a very, very prolonged period of this market internal signal going sideways at the moment. So time will tell, of course, how much of this underperformance we continue to witness. But the bottom line is, in 2 years, the S&P has not really gone anywhere. So far, it actually does make sense, because when this actually started, the S&P 500 and the NASDAQ are basically flat, right? So from 2 years ago, we're back at the same level as where we were. So, one could argue in the last 2 years, we've already not seen a lot of returns and we've basically traded sideways. So we've broken even, but we haven't seen a lot of positive returns from the market. Now, with valuations high and investor sentiment poor, those are the two reasons. Stocks are due to suffer negative returns over the next 12 years, is what he says. In fact, given where valuations stand today, and especially considering how high risk-free treasury yields are at the moment, history shows stocks could drop dramatically, and this was the final conclusion. He says, and I quote, "At present, we estimate that a decline to the 1650 level on the S&P 500, a 65% loss would be needed to restore historically run-of-the-mill S&P 500 expected returns of 10% annually. A level of 1800, a 62% loss, would bring our estimates of expected returns to a typical 5% risk premium over and above the current 10-year treasury yield." So basically what he's saying is that right now we need the markets to pull back 62%, basically see a full-blown stock market crash at an 1800 level in order to see a significant increase in future returns. As I mentioned before in my previous videos, price dictates your future returns, period. The price you pay is going to determine how much money you end up making. If you pay more, you make less. If you pay less, you make more. It's that simple, right? So whatever price you pay for a stock or an ETF or index or equities or bonds or real estate or car, whatever it is, the price you pay is what's going to determine the future returns of your actual investment. So of course, 62% loss, the market's going to drop pretty significantly. There's going to be a full-blown crash, and at those cheap prices, the future returns, of course, are going to be significantly higher once again. And that's going to be a 5% risk premium. That means 5% over and above of what we are currently getting from the 10-year treasuries. A decline down to 2750 on the S&P, a 42% loss, would bring our estimates of 10-year treasuries S&P 500 total returns in line with the prevailing 4% yield on the 10-year treasury bonds as well. And he added that none of these figures are forecasts, but they do represent historically consistent estimates of the potential market losses that would be needed to restore the pedestrian levels of long-term expected returns. And I realize that estimating potential market loss of 40 to 65% may seem preposterous, but as I wrote in March 2000, if you understand values and market history, you know we're not joking. So that's one of the things, and this is something that really is important to put things in context, and that is his forecast and his returns. Not just forecast, because anybody can make a forecast, right? What has he been doing in order to justify his forecasts and his predictions? Because at the end of the day, numbers will tell you the whole story, right? It's not so much the words, it's the actions that we take are what's going to dictate how we really feel about the market, right? One can be super bearish, but if they are positioned long, right, their actions are going to speak more than what they're talking about. So he obviously predicted the 2000 tech stock bubble bursting, 83% plunging. He predicted 2000 the S&P 500 would likely see negative returns over a 10 to 12 year period, and it did. And he also predicted in April 2007 that the S&P could lose 40%, and then it lost 55% in a subsequent collapse between 07 and 09. However, if you take a look at the returns, the recent returns have been less than stellar. His strategic growth fund is down 46% since December 2010. In the last 13 years, the fund has almost been cut in half and has fallen about 12.6% in the last 12 months when the S&P has rallied over 24%. So there's been a significant amount of underperformance in the last year, not to mention the last 13 years as well. And the amount of bearish evidence being unearthed by Hussman continues to mount, and his calls over the last couple of years, substantial sell-off began to prove accurate in 2022. Yes, there may still be returns to be realized in this new bull market, but at what point does the mounting risk of a larger crash become too unbearable as well? So here's a lesson that I want to take away from this entire analysis. Pessimism is what makes headlines, gets recognition, views, and clicks. Optimism is what makes money. It's that simple, folks. Like, you're going to see a lot of pessimism. There's going to be always a reason to not invest, right? As Peter Lynch says, there's always something to worry about. There will always be, in the market, in the world of investing, in the world of finance, in the world where we're dealing with risk every day, there will always be something to worry about, okay? And pessimism and FUD and fear is what's making the headlines and getting the recognition and the views and the clicks, okay? But what actually does make money is optimism, expecting growth, hope. Obviously, I know those are things that are not always possible, but as we grow overall, as there's more technology, as there's more growth happening, as there's more productivity, that's what makes money over the long term. And as I showed you guys a chart in one of my previous videos, if you have a time horizon of over 15 years, the probability of losing money in the market is less than 1%, right? Over a 99.5% probability that you make money over a 15+ year time horizon in the market, because that's how markets operate. They have consistently proven their resilience, their strength to keep going higher. And that's exactly why time in the markets is so very important than timing the market and getting in and out so aggressively that you're constantly in this virtuous cycle of trying to predict and, of course, getting in, getting out, being so active, so tactical that it ends up not working out. That's exactly why time in the market, very, very important. And you can kind of disregard a lot of these things. Of course, they're important things to consider. And that's why I mentioned in my previous videos, and something that's very important, by the way, I do want to mention that we do have our New Year's sale. Definitely to check that out. The 50% off individual courses, coupon code 2024, and 70% off on the entire bundle for all 4 courses, right? So entire bundle is going to be 70% off, coupon code 2024. And this is also only valid for another few days until New Year's. And after that, it will expire. So the link's going to be down below. So final thoughts in conclusion are going to be very simple. Regardless of what happens in the market, I want you guys to be prepared. That's it, right? We need to be prepared for a recession. We need to be prepared for a market decline. We need to be prepared for a bull market. We need to be prepared with cash to take advantage of opportunities. Never, in my opinion, we should ever be predicting one particular scenario and be, kind of balancing or positioning our portfolio with that one potential scenario, because it may or may not happen. It's all going to come down to the probabilities of what we believe is going to potentially take place. So if you believe that there is, let's say, a 50% or more probability that there's going to be a mild recession, maybe you get a little bit more defensive going into next year. You prop up your balance sheets, you kind of save up more cash, you pay off all high interest debt, and you become a little bit more defensive. And if the recession happens, great, you're prepared, you're ready to take advantage of opportunities, you have some cash sitting on the sidelines to deploy and take advantage of deals. And if it doesn't, big deal. At least you are prepared for the worst case scenarios. At least you are prepared for what you believe is potentially going to take place. And that's how we get a lot of mental peace when it comes to investing, because we're constantly dealing with a lot of uncertain variables and risks. So instead of trying to predict what's going to happen, just be prepared for all potential scenarios that have a higher probability of happening. So hopefully that makes sense. And again, make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below. Again, there's a 16% annual discount that's available if you want to be a part of our Money Invest community. We are constantly talking about investing, fundamentals, technicals, trading, options. There's a lot of different strategies, and we have a community of folks from all over the world, very, very successful and experienced traders and investors. If you want to learn from them, we absolutely crushed it in 2023, and we are expecting 2024 to be no less than what we just accomplished. So even better and bigger in the next year. So again, hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below, along with our courses that are 50 to 70% off, coupon code 2024. And as always, happy investing. I'll see you all in the next video.